Okay, let's unpack this. Imagine a global financial landscape where the very ground beneath our feet seems to be shifting by the minute. Traditional anchors of stability, they feel like they're under siege. And the US dollar, the most powerful currency, is, well, it's behaving in ways that puzzle even the most seasoned experts. Our mission today is really to cut through that intense noise. We want to give you a crystal clear understanding of the complex forces at play in the global foreign exchange market. Specifically for the U.S. session, today, July 18th, 2025. We're going to extract the most important nuggets of knowledge from our sources, basically giving you a shortcut to being truly well-informed.
Yeah, and what's truly fascinating here, what our deep dive really shows, is that the dominant market narrative, it's just not a simple calculation anymore. Not just economic growth and interest rate differentials. Instead, we're navigating this really complex equation where unpredictable U.S. policy that's acting as the primary volatility catalyst. This whole environment forces global markets into a fundamentally reactive posture. And later on, we'll definitely dig into which specific currency pairs show the highest potential for, actionable movement, all based on a pretty robust data-driven approach.
That sets the stage perfectly.
Mm.
Our sources, they pinpoint this unique environment as a global macro crucible,
Mm.
forged by three major forces: heightened policy uncertainty, significant central bank divergence,
Right.
and, yeah, acute political risk. Let's
Right.
start with the big one,
Okay.
the primary source of all this market instability.
Indeed. And the very core of this instability, it really stems from the U.S. administration's incredibly unpredictable use of trade tariffs as like a central policy instrument. It's unlike anything we've seen in recent memory, really.
And it's not just targeted measures anymore, is it? We're seeing this broad-based protectionist stance that just creates persistent uncertainty right across the board. For example, our sources detail a threat to impose a whopping 35% tariff on Canadian imports. Then there's a floated plan for a blanket 15% to 20% tariff on most other trading partners, and even, potentially, a 30% tariff on all goods from the European Union. Tentative start date, August 1. It sounds like, I don't know, financial Jenga, where the market is just waiting to see which block gets pulled next.
It absolutely does. And the erratic application of these tariffs, that's crucial to understand. Announcements have occurred after market hours on 3 consecutive days, a pattern described by market participants as, well, relatively random.
Wow.
You mentioned Jenga. I'd say after those 3 days, the trading floors probably felt less like sophisticated financial hubs and more like a high-stakes guessing game. This prevents the formation of any stable economic baseline. It completely transforms the trading environment from one of, economic forecasting to one of pure political risk management.
That's a profound shift. And this pattern of behavior, it suggests a deliberate strategy, right? One that extends beyond just trade policy. Think of it this way. The administration isn't just using tariffs as a trade tool. They seem to be weaponizing uncertainty itself. This volatility provides a kind of public pretext for the administration to demand accommodative monetary policy from the Fed, essentially introducing a significant and, importantly, unquantifiable policy risk premium into how the U.S. dollar is valued. Traditional valuation models, the ones that usually rely on economic fundamentals, they're becoming less reliable because political whim is sort of emerging as a dominant short-term price driver.
Right. And this weaponized uncertainty around trade, it isn't operating in a vacuum. It's intricately linked to and maybe even exacerbated by something equally profound, which is the escalating and very public conflict between the White House and the Federal Reserve. That's sending shockwaves through global financial markets about the central bank's political independence.
Yeah, that's been hard to miss. President Trump has renewed efforts to remove Federal Reserve Chair Jerome Powell. And this campaign, it's broadened from just criticism of monetary policy to include accusations of, well, fiscal mismanagement related to the renovation of the Fed's headquarters. It's really an unprecedented level of public pressure.
Yeah, and stepping back for a moment, the independence of the central bank. It has long been considered a foundational pillar supporting the U.S. dollar status as the world's primary reserve currency.
Right. So this current pressure campaign is forcing markets to price in the non-trivial risk of a politicized Fed, an outcome that could lead to a long-term de-anchoring of inflation expectations and introduce severe systemic volatility into financial markets. The implications are truly significant. So this environment has created a fascinating, almost schizophrenic identity for the U.S. dollar. It's quite something. On one hand, you have this deeply entrenched long-term bearish view. Major research outlets like J.P. Morgan and NBC Economics, they're pointing to fading U.S. exceptionalism and the corrosive effects of this policy decay. And this bearishness is clearly reflected in the futures market. The latest commitment of traders, or COT report, shows sizable net short positions against the US dollar.
Yet, on the other hand, the dollar's short-term behavior is often quite paradoxical. It really is. Resilient U.S. economic data, like that recent report showing June retail sales grew 0.6% against expectations, and jobless claims fell to a 3-month low, that provides strong fundamental support. This outperformance triggers sharp counter-trend rallies. Furthermore, each new tariff threat, while undeniably bearish for the dollar long-term, can trigger an immediate risk-off impulse where the dollar is paradoxically bought as a safe haven asset. It's bizarre.
It's quite the head-scratcher, isn't it? So what's the practical takeaway from this fundamental split? How do you navigate that?
Well, it creates a volatile, whipsaw-prone market. The dominant driver can shift from that long-term structural decay to short-term data and haven flows on a daily or even hourly basis. It means you really can't just pick one narrative and stick with it. You have to be nimble, otherwise you'll get caught on the wrong side of a major swing.
Okay, so while the Federal Reserve navigates this complex political minefield, it seems other major central banks are adopting clearer, maybe more dovish stances in response to both their own domestic economic weakness and maybe the growing threat of U.S. protectionism.
That's the crux of it, exactly. This widespread dovish pivot among its global peers places the Federal Reserve in this unique position, essentially making them the hawk by default. The interest rate differential is widening in favor of the U.S. dollar, not because the Fed is actively tightening policy, but because other major central banks are becoming more aggressively dovish in their guidance and actions. This provides a fundamental, data-driven floor for the U.S. dollar, and that creates a fascinating tension against the negative sentiment generated by all that domestic political risk.
That's a powerful insight. Okay, so given all these powerful conflicting forces, what's the practical takeaway for where the real market action is today? How do we cut through the noise and spot the highest opportunity areas?
Right, that's where our systematic, data-driven approach comes in. We use a proprietary algorithm that scans G10 and select emerging market currency pairs. It assigns a weighted score based on 4 key criteria to filter for the most compelling trading opportunities over, say, the next 24-hour horizon. First, realized volatility with a 30% weight. That measures historical price variance over the last 5 trading sessions, basically, how much a pair has been moving. Then liquidity profile at 20% weight. This assesses average daily turnover and bid-ask spreads, making sure we're focusing on pairs that are actually easy to trade without major slippage.
Okay, that makes sense.
Event risk catalyst gets a significant 30% weight. This quantifies the potential impact of scheduled macroeconomic data releases or, significant unscheduled geopolitical events like these tariff announcements. And finally, sentiment news anomaly at 20% weight. This detects spikes in news volume, social media chatter from influential financial accounts, and extreme positioning as indicated by the latest COT report.
Got it. And based on this robust methodology, the selected pairs for July 18, 2025, they show high potential for significant price action during the U.S. session today. The EU-USD has a total weighted score of 7.4. Both GBP-USD and USD-CAD came in strong with an 8.4. USD-JPY scored a 7.9, and AUD-JPY a 7.4. Okay, so let's really unpack this for each of these pairs now, combining technicals, fundamentals, sentiment, and even those AI insights to give you the complete picture. First up, UUZSD, the transatlantic tug-of-war. Looking at the charts, the price action, well, it's breached the floor of a multi-month rising trend channel. That often signals a new bearish phase. It's currently testing psychological support down at 1.1600. Key support levels just below that are 1.1570 and then 1.1500.
Fundamentally, the stark monetary policy divergence remains a really powerful force. You've got the Fed at 4.5% versus the ECB at 2.15%. That provides a strong underlying bid for the U.S. dollar. The resilience of U.S. economic data, like that stronger than expected June retail sales report, has consistently tempered Fed cut bets. Upcoming U.S. economic data, building permits, housing starts, University of Michigan consumer sentiment, those are going to be absolutely critical for near-term direction.
Right, but sentiment here is deeply conflicted, isn't it? Which makes it a tricky one. Dovish Fed remarks provided a temporary lift, sure, but this was aggressively counteracted by that significant bearish headwind, the looming threat of a 30% U.S. tariff on EU imports. And here's where it gets really interesting. The COT report reveals speculative traders are significantly net long euro futures. That's a crowded long position, making it highly vulnerable to a painful long squeeze if things turn south.
Yeah, and our AI models actually project a high probability of the pair remaining within a defined range, roughly 1.1550 to 1.1680. But the real insight from the AI is this. A break below 1.1570, that specific level, could trigger a cascade of automated stop-loss orders from those large speculative players, turning a small dip into a potentially significant sell-off. So, for EUR-ASD, the projected trend is bearish, with a confidence score of 7.
Okay. Shifting gears now from the transatlantic currency battle, let's turn our attention across the channel to the British pound. Our analysis suggests GBP/USD is truly standing on the edge of the abyss. Technically, it's at a precarious and frankly critical juncture. The price is testing a long-term ascending trend line. This is a true make-or-break support zone, located somewhere between 1.3372 and 1.3390. It's on an 8-day losing streak, which is pretty bad. And a close below this trend line would signal a major technical breakdown. Targets would then include the 100-day simple moving average near 1.3266, and then maybe a more significant target down at the 1.3000 handle.
And the fundamental backdrop for the pound is, well, unequivocally bearish. The UK economy is showing clear signs of deterioration. GDP contracting for a second consecutive month, the unemployment rate rising unexpectedly. This has led to a dramatic repricing across the market. Investors now fully expect the Bank of England to implement a rate cut at its August meeting. It's a tough environment for sterling.
Yeah, definitely sounds like it. And sentiment is overwhelmingly bearish, which, usually means there isn't much upside potential left. The COT report also shows speculative net long British pound futures. Again, that's a crowded long positioning. It just creates this high-risk scenario of capitulation. It feels like many traders are caught on the wrong side of this move.
Our AI models, they assign greater than a 65% probability of a sustained move down toward the 1.3250-1.3370 if that critical support around 1.3370 fails to hold. And here's what's key from the order flow perspective. A significant volume surge on a break like that would strongly confirm institutional selling and the capitulation of those trapped long positions. So for GBP/USD, the projected trend is bearish with a confidence score of 8. Pretty high conviction there.
All right. Now, let's talk about USD CAD, the tariff bellwether. Technically, we're seeing clear signs of a bullish reversal here. It's broken a descending price channel and has cleared the 50-day moving average. There's bullish pressure building on the key resistance level of 1.3750. A break above that could target 1.3798 first, and then maybe a move towards 1.4000.
Yeah, and this pair is driven almost exclusively by the U.S. tariff threat against Canada. That effective rate could potentially be as high as 7.7%. This policy risk is compounded by underlying weakness in the Canadian domestic economy, particularly the labor market. Prime-age unemployment is hovering near 6%. That gives the Bank of Canada a very distinctively dovish tilt compared to the Fed.
And sentiment for this pair. It's executed a sharp reversal and is now firmly bullish. What's truly telling is the decoupling of the Canadian dollar from oil prices. Even with WTI near $68, the CAD isn't really benefiting. This really underscores the overwhelming dominance of that tariff narrative. Plus, the COT reveals an extremely large net short position in USD CAD. That's an exceptionally crowded trade, making the market highly vulnerable to a painful and rapid short squeeze if it breaks higher.
Absolutely. Our AI models indicate a high and increasing probability of a bullish breakout for USD CAD. A significant surge in trading volume accompanying a break of that 1.3750 resistance, that would be a powerful confirmation signal. Simulations project a potentially rapid and volatile move up toward the 1.3900 level. So the projected trend for USD CAD is bullish with a strong confidence score of 9. That's our highest conviction call today.
Okay, moving on to AUDGPY. A race to the bottom. From a technical perspective, this one seems trapped in what feels like a no man's land. 97.00 is acting as a key pivot point. It's largely just consolidating, lacking a clear directional driver right now.
Fundamentally, both currencies here are burdened by significant headwinds. It really does feel like a race to the bottom. The Australian dollar is under pressure from a very weak June employment report. Unemployment unexpectedly jumped to 4.3%. That pretty much cements expectations for an RBA rate cut at its next meeting in August. The Japanese yen, meanwhile, is being sold due to acute political uncertainty stemming from that upper house election on Sunday. That could easily lead to policy paralysis.
So sentiment is bearish for both individually, which isn't a great sign for the pair overall, I guess. And the JPY's traditional safe haven appeal, it seems like it's being completely overridden by those domestic political factors right now. The COT shows speculators are net long AUD futures and simultaneously hold a massive net short position in JPY futures. Interesting positioning.
Yeah. It is. Our AI analysis identifies the Japanese election as the dominant variable here and a classic binary event risk. It projects consolidation and range trading leading into the weekend, followed by a potential high volatility breakout as those election results are digested. And here's the kicker. Any catalyst sparking a JPY rally, maybe a surprise election outcome, will likely be significantly amplified by the potential for a violent short squeeze given those massive shorts. So for AUD JPY, the projected trend is sideways, but with a low confidence score of 4. Very low conviction.
Right, makes sense with that election looming. Finally, let's turn our attention to USD JPY. Policy divergence versus political risk. Technically, it's been in a strong and sustained uptrend, driven by fundamentals, as you said, successfully breached 148.00 and is now actively testing the area around 149.00. However, signs of potential exhaustion are beginning to emerge. There's a bearish divergence forming, which means prices are still moving up, but the underlying momentum is actually weakening, and there's a potential double top pattern forming above 149.00, which can often precede a reversal.
Yeah, the primary driver here remains that widening monetary policy divergence. You've got rising U.S. Treasury yields, the passive Bank of Japan, Japan's core CPI easing to 3.3%. It all points higher fundamentally. But this clear fundamental picture is heavily clouded by that major event risk, the Japanese upper house election scheduled for Sunday. This has the potential to dramatically alter Japan's political and fiscal landscape, which in turn could trigger a sharp reversal in the yen.
Okay, so sentiment is bullish, but tempered with a significant degree of caution, it sounds like. Strong U.S. economic data and that passive BOJ stance certainly support the upside. But paradoxically, the very factors that are negative for the Japanese economy, like the looming election and stalled U.S.-Japan trade talks, they're currently acting as a tailwind for the USD-JPY pair by simply weakening the yen. It's counterintuitive. And the COT reveals, again, a massive net short position in the Japanese yen, an extremely crowded trade.
Exactly. Our AI model highlights the Japanese election as a classic binary event risk, resulting in what's called a bimodal probability distribution. Basically, two likely outcomes. One peak is around 150.0 if the election result is negative for Japan, reinforcing the yen weakness. The other peak is below 147.0. That would be a positive surprise for Japan, potentially causing a massive JPY short unwind. This extreme short positioning is the dominant feature here, making the pair particularly dangerous to trade through the weekend. So the projected trend for USD-JPY is bullish, but with a low confidence score of 5, directly reflecting that looming binary event risk. Stepping back then, the synthesis of all this multi-layered analysis points to a U.S. trading session that's really dominated by these conflicting forces. Resilient U.S. economic data on one side, escalating global policy risk on the other. It's a true crucible.
That makes sense. And it means the U.S. dollar's bifurcated identity, acting as both a fundamentally strong currency and a politically risky one, that's likely to lead to divergent performances across the major pairs today. It's definitely not a one-size-fits-all dollar story right now.
Precisely. The most actionable opportunities appear to be in pairs where the factors align for a clearer move, like we saw in GBP-USD and USD-CAD, while pairs exposed to that binary event risk, like USD-JPY, they require extreme caution, especially if you're thinking about holding positions beyond today's session.
Okay, so just to give you a clear summary from our analysis. For USD, the projected trend is bearish with a confidence score of 7. For GBP-USD, it's bearish, confidence score of 8. USD-CAD is bullish, with that very strong confidence score of 9. AUD-JPY is projected to be sideways, but with a low confidence score of 4. And finally, USD-JPY is bullish, but again, low confidence score of 5 due to that significant binary event risk over the weekend. So what's the ultimate takeaway here? We've cut through the noise, we've unpacked complex policy decisions, and even glimpsed into the strategic minds of market players and AI models, all to give you a clearer, more nuanced picture of what's truly driving the dollar and other major currencies today.
Yeah, and this raises an important question, I think, for all of us to consider beyond just today's trading. What does this increasing level of political influence and unpredictable policy action on financial markets? What does it mean for the long-term reliability of traditional economic models? And, how might that reshape global investment strategies going forward? Something to think about.
Definitely a lot to think about. We encourage you to reflect on these insights and to continue your own exploration of these crucial topics.